Hey everyone, me Kevin here. I am back, and boy oh boy, we gotta buckle up for what's coming up next week. This is going to be wild. But before I go through the schedule with you, I want to show you what some of the Wall Streeters are talking about. So let's get right into it. Here we go. Bank of America says, hey, this is like a bubble dream. The Fed is cutting, oil is crashing, China is printing money. This is perfect. People are going long gold as an inflation hedge. They're going long tech, and everything else is a trade because we're going straight to the moon. Their bull bear indicator, by the way, is midpoint. I was actually surprised it wasn't a little bit more on the bullish side of the scale because it feels like things have been pretty dang bullish. But hey, it's their indicator, so I guess they can determine how they want. I've been a little more nervous about labor, but we are going to talk about what happened with that savings number today in a little bit more detail. And I did find it interesting that Bank of America clients were actually adding more money to the 10 and 2-year Treasury notes rather than the very short-term 4-to-1 week, which were started declining over here. And then very little there to the 20-30 year. This, by the way, 20-30 year is seen as a recession hedge. And since a lot of people don't think there's going to be a recession, maybe that's why there aren't a lot of inflows in that. But I did want to look in here. I wanted to see if they had August in their bull-bear scale. They actually didn't. They had extreme bullishness as February of 2018, January of 2020, and then extreme bearishness as October of 22 and October of 23, and they called those buy bear points. That's funny. That's right around when I launched my fund. But anyway, take a look at the CNN Greed and Fear Index. If you look at the Greed and Fear Index, we're almost solidly in the, we're certainly solidly in the greed category. We're almost in the extreme greed category. Market momentum, greed, extreme greed on stock price strength and breadth. In other words, more stocks going up than going down. And then the put call volume, this one's the scariest to me because this one can sometimes signal shocks coming up. Because usually after the put call volume gets this low into that sort of like under 65-ish level, under 70-ish level, you usually end up having this pretty large ramp up in put buying and protection buying, basically. And you might be able to line that up with what's going on in markets. But what's most important is take a look at where we sit right now. We sit at about a 0.66, which we've only been lower than this for this area once, twice in about the last year. So we're getting pretty dang bullish where people are like, I don't want any puts. This is leading some, like the Marketeer. I was reading them a little earlier. They're like, maybe it's a good time to pick up some downside protection because downside protection is something you get when you don't need it and you don't even think about wanting it because by the time you need it, it's too late. Interesting. I'm not the biggest fan of puts, mostly because I think you really have to play the timing on it well. Sometimes I play it really well. Like, for example, I bought a put on Tesla this morning, sent an alert to everybody in the Stocks and Psych group, and it was up 61% on that trade, and I'm like, boom, I'm running the register. Now, of course, Tesla ended higher, but that's okay. It was just a trade on the roller coaster, right? That's fine. I don't have any other shorts or puts on any kind of stocks. So what we have over here is volatility actually pretty neutral right now, though we did have a little bit of a tick up in the VIX. And some on Wall Street were saying that little tick up there on the VIX was like a sign that the VIX is getting ready to wake up. Maybe, but that's probably because of the calendar we have coming up, not necessarily a bad omen. I mean, think about what's coming up. Next week, we're going to get the ADP employment report. I'm going to give you some of these numbers, and then we'll talk about a little more with what happened with that savings rate today. So obviously PCE was good. We already talked about that. On the 1st, which is Tuesday, we're going to get the JOLTS numbers. Okay, this is labor related, so it's going to be a big deal. Everybody right now cares about labor, including myself, because if we can actually start getting growth again in jobs, which would be remarkable, but you might actually stick a soft landing even with those downward revisions that we've been getting in labor. So you want to start pricing in recession. You want to see jobs come in under 100,000. You want to start pricing in soft landing. You want to see jobs coming in over 180,000. That's usually what I like to see, somewhere around 90 to 100. Under that, once we start breaking that range, it's bad. Like you get sub 50, you're probably going into recession. So that 90 to 100 is a good level to watch. And a good level to watch on the flip side, in my opinion, is at like 180 level before you start trending back up to 200. So watch it. I think the data is going to tell us that, honestly, within the next 5 to 6 weeks here. This is the time to tell us. And you'll see why. So mark your calendar. October 1st, you get the JOLTS report. Then you get ADP on October 2nd, which is Wednesday. We're expecting 125,000 jobs. It's pretty good. And ADP is usually the more bearish one, and that's actually a turn up. The last estimate for ADP, well, actually, the last result for ADP was 99,000. Now we're looking at 125. That would kind of suggest that like July and August got slapped a little and like something weird happened there. And now everything's kind of back and the party's back. It's like the power went out for a second and everybody's like, oh my gosh, it's the start of the end. And then the power came back on. It's like, no, it's not even the generator. That's just normal power. Like, we're good. Like, we're not even coming in for a landing. We're good. Keep flying the plane, okay? What are we circling the airport for? So then we have the actual jobs report, which comes out 2 days after that, Friday the 4th, and the current estimate is 146,000. So in order for you to go like mega bear here, keep in mind you get like ISM prices paid here twice, once on the 1st and once on the 3rd. The 1st will be manufacturing, the 3rd will be for services. So we'll get a little bit of a read on inflation again, which is good since we had the S&P PMIs that came in a little warm last week and started pushing commodities up a bit. So those could affect bonds or inflation concerns a little bit in gold. Watch those. But otherwise, everyone's going to care about labor. JOLTS, ADP, then the jobs report. If this jobs report comes in hot and knocks it out of the park, it's going to be kind of hard to start arguing, even with big revisions. It's going to be kind of hard to start saying, recession's right around the corner. Because quite frankly, that it just, even if you revised it down by 30%, it would still be really good, right? If the estimate is 146,000, and let's say it comes in at 160,000 beat, or goes up to 160,000, so 14K beat, which seems relatively reasonable. That'd be within standard deviations here. So let me go down 30%, just to take 30% off and see. I would be down at, times 70%, 112, still in the positive direction, even after the revisions, and I'm actually going up, not down, right? Because the last release was 142. So you kind of start creating a trend up. And see, what I always like to do is I like to invest in markets when there's peak uncertainty. So, I mean, I wouldn't be surprised for you to have red going into the labor market reads next week. And if the labor market reads come in weak, JOLTS, ADP, jobs, market's just really going to tank. Because everybody thinks the labor market is going to be that sort of canary in the coal mine for recession. I don't really believe that. I actually think when the labor market starts telling you you're heading towards recession, it's too late. I think what's more likely to lead to a recession is some kind of market correction that comes as a result of some form of World War III fear, although so far the market has not cared at all. It's kind of like the market's almost like cheering on Israel, taking out like every freaking Hezbollah person they can come across. Because the more and more that war expands, the more and more the market just keeps going up. So I actually think we're going to get too much scary news out of the jobs reports because, I mean, let's be real, that's the last thing to roll. Really, I think what people should be paying way more attention to are going to be earnings, that third quarter earnings set. Earnings start like 2 weeks after we get this jobs report. I don't even care about the CPI report that comes out, a week and a half or whatever after the jobs report. I think that'll be fine, just like the PCE report that we got this morning, or CPI last week. I think what'll really matter are earnings. And that's what I most look forward to, because those earnings won't tell me about this quarter. Who cares about this quarter? I want to know about Q4. What are companies seeing going into Q4? I want to hear commentary from Domino's on the 10th, Delta on the 10th. I want to hear the banks start reporting. How are defaults going? I get JP Morgan, Wells Fargo, Bank of New York Mellon, and Fastenal for some construction numbers. I get all of those before the market open on October 11th. You got Tesla's Robotaxi Day on the 10th, which will probably be a buy the rumor, sell the news. But then you're going into the 18th for earnings, which frankly, a lot of people think earnings are actually going to do really well. There are a lot of people who are upgrading what they think earnings are going to be and what deliveries are going to be for Tesla for this next quarter. So frankly, there's kind of like, it's almost like a lot of people feel like things are kind of like, slowly going on the up and up trajectory, which is nice. And the downside risk, jobs. But again, we get a good jobs report here, fantastic. Now, the worst case scenario is you get a bad jobs report, because if you get a bad jobs report next week, or just bad data across the board next week, then it's going to amplify how important earnings are. Like, let me rephrase that. If you get good jobs data, honestly, do we really care that much about earnings? Yes, we do, because the earnings are going to be the leading indicators, but the stock market will go in frothed up on the back of good labor data. So, it's not that bad. Then, of course, you'll have election uncertainty, but honestly, I feel like we've already got so much election uncertainty. I mean, look at the betting markets for the presidency. You've got predicted kind of showing Kamala Harris had like a 9-point lead. You've got the New York Times saying the latest polling puts both of the candidates at razor-thin margins in the battleground states. Polymarket puts Kamala at 51, Donald Trump at 49. You've got the current estimates for Tesla deliveries at about 460 to about 465. Honestly, not bad. It's pretty decent. It's all going to come down to what margins are going to be, but frankly, it puts Tesla on track to get to about 1.8 million deliveries, which is flat year-over-year growth. It's not great, but it's better than substantially negative. So, I was like, all right, no problem. So, not bad. Then, in terms of really pricing in the market, usually markets look post-election and go, cool, uncertainty is gone, time for the markets to moon. I think that is such mainstream knowledge at this point that we've kind of already priced that in. So, I think the way to kind of reconcile all of this is sort of look at what is left, like what can actually make the market go down and doesn't need to go down. Well, I'll answer the second one first. No, the market does not have to go down. But for the first thing we have to think of is labor lags, but freaks the market out. All you have to do is look at the July labor report and you'll see how the market freaked out. I mean, it flushed out the black swan of the, Japanese carry trade. So, and that was all in a labor report. So that actually makes next week probably the most important for price action, but frankly, less important for recession risks. Like, the way I look at recession risk is you kind of go this way. You go market crash / black swan. Then you get prices go down. Well, that's part of market crash, right? Then you get layoffs. Then you get earnings down. Then and unemployment claims that go up. And then you get labor down, and then you have recession. So if you think about it in this pattern, really, absent a black swan, you don't really get the layoffs. Ironically, though, a bad labor report could be the black swan, just like it was in August. So it's a little complicated to understand. But next week is really important for what the market reacts with. And that could create a cycle of uncertainty and be amplified by earnings. So here are sort of the two paths, okay? Path one, bad labor week amplifies any earnings misses, people take profits and fear into election, okay? Path two, good labor week. This buffers any earnings miss. In other words, you could miss and it wouldn't be that bad, right? People buy dips on misses, and who cares on election? It's kind of what I think we got going on that actually makes next week potentially the most important week for this cycle. So how do you play it? Well, I mean, honestly, I think 1 week puts going into it on Monday are going to theta decay like crazy. Probably decay way too much going into Friday. So you probably, if you were to get puts, you probably grab like October 20s just to give you a little bit more breathing room, or just go, 90 days out, right? The other thing that you could do is if you get a bad labor report, something you can hedge with, you could hedge with long treasuries, because we should have low inflationary readings next week, like PCE, maybe, right? And labor crash should dump yields, especially with Fed speak, which would amplify the promise of Fed intervention. Think about that. Stock market go poopy doopy next week because of the labor market. You're going to get Fed speak that's like, we're going to be really aggressive about the labor market. You'll get the Goolsbys coming out going, oh, we need to cut by hundreds of points. Okay, good, great. I mean, that actually, them reacting increases your chances again of a soft landing. So next week's big. 1 week is probably too much. If puts, you probably go out October 20th or 90 days out. You just have to be careful with the theta decay, and then obviously how long you want to hold on to these. You could hedge with treasuries, which are a little less volatile. I don't love the triple leveraged ones, but there are plenty of options for longer treasuries. TLT is an example of one. But I also have positions in TLT, so I'm not trying to just. I hate, like, I always like to disclose, like, if I'm saying something related to my book, I don't want people to think that's the point of these videos. It's just, I always just like to be transparent with my thoughts. Really, I don't think that, you need to necessarily say, oh, I'm going to sell everything and go all cash. I don't think that at all. But I think that starts happening if you get path one, because you can hedge going into a bad week with some of these options. You don't have to be all cash, but this fear into the election, that could be dip buyable depending on earnings. See, now this is interesting. Get bad labor outlook, but earnings are like, hey, we hit a bump and everything's coming back on the up and up. That's when you buy that dip on earnings. So that could be an entry. Interesting. So that would be, think Friday or week thereafter, before you really get the earnings rolling out, before earnings. Or just wait for the earnings. I guess then you can determine. It depends what you want. So it would be Friday or after earnings. Okay. Unless, of course, whatever sell-off happens on labor keeps going for a while. But these are just some things to think of. Okay. So if you don't, this is sort of number two. If you don't get anything out of labor, then you're really just twiddling your thumbs for a black swan. The reason I say that is, at least based on the current data, yes, there are certain parts that are doing very, very poorly in the economy. Restaurants are doing very poorly. Temp job openings are doing very poorly. New hiring's doing very poorly. Construction job openings, architectural billings, real estate market's still a little in the poopy in many different parts of the country. With the exception of the underbuilt. We did just get the savings rate that got revised up. This was actually a note from Goldman saying there's a chance the savings rate was low because of unmeasured interest income and labor compensation received by households. Okay. And then at the same time, we also saw GDP go up to 3.1%. So savings rate got revised up almost 2%, which was wild. And GDP went up today. Look at this. This accounts for the National Association of Realtors. A decline in the nowcast of the personal consumption expenditures growth was more than offset by an increase in real gross domestic investment growth. In other words, this section, which had turned negative for a while, I guess turned positive enough to boost this up, as well as net exports. Okay, so all of a sudden, I guess GDP is on fire again, which is pretty remarkable. But you look at this in whole, it all comes down to the labor market. Bank of America talks about that too. You know, they're under the impression that we're going to have a 150K over here. But if the labor market holds with the numbers we talked about, I don't know that there's a reason to be horribly bearish. So I think that does make me more bullish on sort of my bear bull scale. But I'm going to wait to make any kind of prediction on how bullish until we actually get our jobs numbers next week. JOLTS, the ADP report, and the official report. Because if ADP comes in super low, you know, I use that as sort of my way of like sussing out the jobs report from the BLS, which always seems to get revised down afterwards. So you have to kind of account for that already. J-Pal said so himself. But overall, I think this is a reasonable path. So the reasonable path is watch what happens next week, because you should have max uncertainty at some point over the next 30 days. Let's write that down. Max uncertainty over next 30. Why? You have, strikes inside of Russia by Ukraine. You have, these strikes by Israel and an escalating Iranian threat. You have gold and oil sussing something out, maybe, right? Is it an inflationary risk? Is that why gold's going up, or is there a larger risk going on? You still have problems with the lower end consumer, restaurants, construction, temp jobs, and hiring. All no bueno. Obviously, we also know that 50 to 90 BP uninverted is usually where the recession begins. We are close. Like, next week could make this happen. Next week could make this flip. I mean, think about this. Just so you know where we sit right now on the 210 yield curve. Okay, 210 yield curve right now is 19. Okay, so if we're at 19, here's the way to look at this. Let me get the 2-year quickly. Okay, bonds. The 10-year is 3.75, nice round number, 3.557 on the 2. Right, so the way you could do this is you get bad jobs data, and this is how quickly it'll happen. Bad jobs data, 2-year drops 75 BP to 2.75. 10-year drops, I don't know, call it 25 BP to 3.5. Now your 75 bips uninverted, boom, recession cam. It doesn't even have to be that wide. Like, you could literally go down to 3.25 on the 10-year. Or you could go down to 3 on the 2 and 3.5 on the 10. And then your 50 basis points inverted. Boom, recession camp. It could literally happen next week. Obviously combined with election uncertainty. Do I think that earnings could be the catalyst that pulls this off? Less likely. Mostly because, that's idiosyncratic. I mean, you did see that with Supermicro Computer, where Supermicro goes down and drags the whole market down. But, to get sort of a systemic movement, I feel like labor would be what does it. So that's my take. I want to just give a thorough update here on sort of everything that's on my mind and what I'm watching. This labor report will be the labor report based on September, mind you. So we'll actually get some September insights here. The next point where I think you might really have more labor uncertainties Probably be January. Those would be sort of post-election, post-holidays layoffs. Anyway, there you have it. Thanks so much for watching, folks, and we'll see you in the next one. Goodbye, and good luck out there.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.